The dictionary defines bias as unfairly prejudiced for or against someone or something. As such, the word has a negative connotation. And wait, it doesn't stop there. Biases while investing can also have a negative impact on your overall investment returns. Today, let's look at 5 common behavioral biases so that we all can steer clear of them while investing. The first one is the anchoring bias. First things first, and important too. Whenever you buy something online, if you notice, the MRP on the price tag will be much higher than what you have paid. The MRP becomes the anchor price that makes you feel that you got a good deal. Interestingly, this phenomenon is well defined in the world of finance. It is called the anchoring bias, which simply exists when you focus more on one piece of information or detail and disregard everything else. For example, the shirt that you bought for $1,500 may be expensive, but you will still feel that you saved money because you are considering only the MRP, the anchor, which is $3,600. This bias can cause losses in the world of investment too. Say, Fund X underperformed the benchmark over a 6-month to 1-year time frame. This short-term underperformance is the anchor that caused you to become biased against the fund. However, since the market keeps fluctuating, Fund X holds a chance of performing well in the future. So, you must always keep an open mind and do a thorough analysis before making your choice. At a fair, you inadvertently get pulled to the stall with the maximum crowd. This behavior, called the herd mentality, is quite common among investors too. Consider this. It makes sense for your friend who wants to take an international trip next year to invest in debt mutual funds. Some debt funds are relatively low risk mutual funds that can offer stable returns in the short term. But if you on the other hand want to buy a house after 10 years, equity funds can be your go-to investment. Such funds are more suitable for meeting long-term targets because they need enough time to tackle market volatility and perform well. However, if you do what your friend does, you might end up falling prey to herd mentality and eventually lose out on the opportunity of fulfilling your goal. I have a friend who believes that a keto diet is the best way to lose weight. His Google search goes like, why is keto diet the best? How has keto diet helped people lose weight? Why is keto diet magical? This is confirmation bias. It is this bias that is making him read only information that is supporting his belief and at the same time compelling him to ignore anything that is against it. Now let's talk about how confirmation bias can hurt investor interests. Say, much like most Indians, you believe that life insurance or a PPF is the best means of saving tax under Section 80C. Now, if you have a myopic perspective and you keep on learning about the pros of your chosen investment, then you are influenced by confirmation bias. This bias is keeping you from exploring smarter tax-saving investments such as ELSS. ELSS not only helps you save tax on up to 1.5 lakhs annually, but also lets you tap into the potential of equities for building wealth. I'll be honest, whenever I think of a vacation, I only think of my favorite destination because I'm too scared of wasting my precious days at places that I may not like. By doing so, I know that I'm giving up the possibility of exploring and enjoying other places that could be much better. But I want to be safe. In investing, this tendency is called the loss aversion bias. This means that you're obsessed with avoiding a loss, even if it means letting go of potential gains. Now, this is the reason why many investors will invest in a fixed deposit, even if they have the risk appetite to invest aggressively in options such as equity funds and create wealth. Equity funds may be volatile in the short run, but they possess the potential to generate inflation-beating returns in the long run. If a popular and strong cricket team loses a few matches in a row, people start viewing them as being incapable of winning the finals. But we all know this is not true. Considering recent events to make decisions is a bias called the recency bias. And it certainly has a big impact on your ultimate investment returns. You will see that many investors chase mutual fund schemes that have done well recently without evaluating any other data point. But instead of assuming that a well-performing or a poorly performing fund will continue to do so in the future, you must base your decisions on other aspects such as its long-term performance, the fund manager's track record, the expense ratio, the exit load, etc. To sum it up, be it your day-to-day activities or investing, you must stay clear of biases. Instead, you must look at things from a broader perspective for a smoother journey. Understanding your goals and risk appetite, staying educated and informed about market developments, and having a concrete investment plan can help you become a better investor.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.